Pranam sir, I am S. Ashwin from 4 BTech ECEA and I am here to speak on the topic macroeconomic policies for this selfie seminar. So the macroeconomic policy, it is used to maximize the standard of living and it is used to achieve stable economic growth. So the macroeconomic policy is essentially classified into two main divisions. The first one is the monetary policy and the second one is the fiscal policy. So now we will see what is meant by monetary policy. The monetary policy in brief, it is regulated by the central bank and the commercial banks. In case of India, it is regulated by the Reserve Bank of India, that is the RBI. So the monetary policy refers to the steps taken by the RBI or the Reserve Bank of India to regulate the supply of money and credit in order to achieve the socio-economic objectives of the economy. The monetary policy influences the supply of money or the cost of money or the rate of interest and the availability of money. So there are basically 6 objectives of the monetary policy. We will see one by one. The full employment. It is an important goal not only because unemployment leads to the wastage of potential output, but also because of the loss of social standing and self-respect. The price stability. One of the policy objectives of monetary policy is to stabilize the price level. Both the economists and the laymen favor this policy because fluctuations in the prices bring uncertainty and instability to the economy. The economic growth. One of the most important objectives of this policy in recent years has been the rapid economic growth of an economy. The balance of payments. Another objective of the monetary policy since the 1950s has been to maintain the equilibrium in the balance of payments. And the next one is the controlled expansion. The control of the business cycle, promote the export and the substitute the imports of a country. To regulate and expand banking, give directives to different banks for setting up branches for promoting agriculture trading. Now we are going to see what are the tools of the monetary policy. So basically the tools of monetary policy are classified into two main divisions. The first one is the qualitative tools and the second one is the quantitative tools. So now we will see what is meant by qualitative tools. So the qualitative tools include the margin requirements, selective credit control, moral suasion. And the quantitative tools are basically classified into direct or selective or and indirect or general. So in the direct quantitative tools for the monetary policy or the CRR, that is the cash reserve ratio, the SLR, that is the static liquidity ratio, and the reference facility. So the indirect quantitative tools of the monetary policy include the repo rate, the reverse repo rate, the bank rate, the MSF. The MSF stands for marginal standing facility, and the base rate, the MCLR. The MCLR stands for marginal cost of funds based lending rate. The OMO, that is the open market operations. The MSS, that is the market stabilization scheme. The LAF, that is the liquidity adjustment facility. Now we will see what are the limitations of the monetary policy. So the monetary policy is basically a long-term policy, but it cannot change the long-term growth. So it is obviously a limitation. And then there is no long-term trade-off between the growth and the inflation. The monetary policy can deliver low and stable inflation, thereby reducing the volatility of the business cycle. It really cannot predict when inflationary pressures builds up. So now we will see what is meant by fiscal policies. The fiscal policies in brief, it basically depends on the government income and the government expenditure. Now, the fiscal policy, it is concerned with the rising of the government revenue and incurring of the government expenditure. That is to generate revenue and to incur expenditure. To generate revenue and to incur expenditure, what the government should do, the government there frames the policy called the budgetary policy or the fiscal policy. So the fiscal policy is concerned with the government expenditure and the government review, as we have seen in the previous slide. In broad form, the fiscal policy refers to that segment of the national economic policy which is primarily concerned with the receipts and the expenditure of the government. In India, the president and the state government together control the fiscal policy, and in US, the Congress and the president makes the fiscal policy through the federal budget. The types of the fiscal policy. The fiscal policy is basically classified into two main divisions. The first one is the contractionary policy and the second one is the expansionary policy. In the contractionary policy, in brief, what we can it is used to maintain the inflation. So the taxes are reduced and the government spending will be increased. In the expansionary policy, it is used to combat the recession. So the taxes are reduced and the government spending will be high. Now, what are the types of the fiscal policy? As we have seen, the contractionary fiscal policy, this is used during the period of excessive inflation. The government basically can do two things, that is increase the taxes or decrease the spending. In the expansionary fiscal policy, during it is used to combat the recession or the contraction. So the government basically does two things, that is decrease the taxes or increase the spending. There is another type which is discretionary fiscal policy, which is mainly used in the United States of America by the Congress. The discretionary fiscal policy is a portion of the federal government's action that can be changed year to year by the Congress and the President. So it is basically updated year to year. It is usually executed through each year's budget or through changes in the tax code. Now, what are the advantages of the contractionary fiscal policy? When it is used? So the contractionary fiscal policy is basically used by the government when the government policy makers cut the spending or increase the taxes. They engage in contractionary fiscal policy. The governments may enact contractionary measures to slow an economic expansion and prevent inflation. So increasing the taxes means people have less money to spend. So the less money, it basically means less demand. So the less demand means lower inflation. So it is used to combat the inflation. So instead of increasing the taxes, we can also decrease the government spending. So this means less money in economy, or this less money, it means less demand, and less demand essentially leads to lower inflation. Now, expansionary fiscal policy. Expansionary fiscal policy uses the government spending, reduced taxes, or the combination of the two. The government has to decide how it is being framed. The chief objective of a fiscal expansion is to increase the aggregate demands for goods and services across the economy, as well as to reduce the unemployment. Decreasing the taxes means giving people more money to spend. More money essentially means more demand. More demand means more production. More production means more jobs, and more jobs means more demand. So there will be very less unemployment in this stage of fiscal policy. The next one is it increases the demands for goods. We can increase the demands for goods, and more demand means more production. More production means more jobs. More job means more demand. So it is essentially used to combat the recession. Now, what are the effects of the fiscal policy? Effects of the fiscal policy mainly refers to the unemployment. The governments often choose to develop the fiscal policies that attempt to decrease the stable rate of unemployment. The expansion. In the expansion, that's what we use the expansionary fiscal policy. So here the governments work to encourage the economic growth as a whole, funding expansion through subsidies, tax cuts, and new contracts with domestic and international partners. Contraction. This what we use the contractionary fiscal policy. So the contractionary fiscal policy, where the governments that are worried about inflation, they can attempt to decrease the inflation rates to contraction using fiscal policy to rein in natural inflation. So there are also inflation issues that are the major effects of the fiscal policy. Now, the highlights of the relation between these two policies. These both policies are used to achieve the macroeconomic objectives. As we have already said, this is the macroeconomic policies. So this is used to achieve the macroeconomic objectives. So both the policies, they influence the output and the input interest rates. They help to obtain optimum policy mix. That means both the policies can be used, and it gives us an optimum policy mix. Next one. Which is more effective, monetary policy or the fiscal policy? The monetary policy is essentially set by the central bank and therefore reduces the political influence, whereas the fiscal policy can have more supply side effects on the wider economy, that is the tax cuts, subsidies, everything. So the monetary policy, it is quicker to implement, and interest rates can be set every month. So it is basically updated every month. The monetary policy in a planned economy like India cannot be framed independently of the fiscal policy. So the fiscal policy has to be used in combination with the monetary policy in an economy. And in India, the RBI, that is the Reserve Bank of India, has often adopted monetary policy to government's fiscal policy. Now, the conclusion. So the fiscal policy, it is more successful in controlling depression. The fiscal policy does not provide a complete substitute for sound monetary policy. The effects of the fiscal policy are more direct as it involves shaping of the tax structure, determination of the amount of tax revenue and volume, as well as direction of the public expenditure. Obviously, there are limitations of the fiscal policy. The limitations of the fiscal policy, it basically means it's unpopular to raise the taxes or cut the government spending. So the elected officials worried about the re-elections, they rarely do either of the expansionary fiscal policy or the contractionary fiscal policies. And that's it from me. Thank you, sir. Thank you.